Fios is not cable. We're wired differently, which means you can get the fastest internet available with equal upload and download speeds from 50 to 500 megs. So you can upload 200 photos before your favorite song is finished. Click the ad and switch to Fios today to get our best offer ever.
This is a download from BFM 89.9, the business station.
Thank you for listening to this podcast from BFM 89.9. I'm Mira Sivasudi. Now, after 8 years on the air, we're bringing the bigger picture's health and living to you, live, on the ground. A whole day with the experts, debunking myths behind heart disease and diabetes, addressing our love affair with food. And of course, George will be there talking about sperm. So join us at BFM's Health and Living Live 2016 on Saturday, 2nd of April. Go on and register at bfm.my/health.
Now, good morning, Dodge. We've had some time to process the European Central Bank's stimulus package last week. What do you think of the market reaction to Mario Draghi's announcement?
Good morning, Melissa. Well, Friday's trading was really curious coming after Thursday's equally oddball session. Market internals were more likely driving the market. So the euro market was a bit more illiquid than normal given the lack of conviction about what the ECB might unveil. Then the ECB hit them with both barrels, both unveiling a larger package than expected and also suggesting that would be all it does. So the euro trade fell sharply. The shorts got caught out of the position in an illiquid market, which sparked the furious rebound. But when you look at it, the euro currency is about where it was when before the announcement. So I do think it's going to affect trading. I do think that stocks are going to go higher. Investors are beginning to digest the pivot of the ECB away from negative rates and towards buying corporates. So the central bank will probably use asset purchases to stimulate the economy, and the purchase of blue chip stocks is a real possibility. So we're going to be watching that. We're going to be watching corporate bonds, which were explicitly mentioned by the ECB, where most sectors will rally over the weeks ahead. Investment-grade non-financial bonds will rally, French and German credits, utilities, transport, energy, basic industrials. All those are likely to benefit from the ultimate conclusion of what the ECB indicated.
Dodge, if I could use your words, the oddball reaction to the ECB, analysts are saying that reaction, in fact, goes to show that perhaps the market has diminished faith in the ability of central banks to stoke growth and inflation in what is already, amid negative rates already. Do you agree with some of those comments?
Unfortunately, I do, Melissa. I think that the oddball reaction can be identified by very specific and direct market circumstances, but ultimately the fact that there was an oddball reaction both ways does indicate that you can only use a bazooka so many times, and then the market gets desensitized by it. Also, as a world, we really want to go away from relying on low interest rate environment to more fundamental strength of individual countries and companies. And with the fact that the bazooka was used again indicates a potential delay in our transition towards more fundamental and market valuations away from low interest rate valuations. And so I do think that because of that, yes, I think that the effect, that the result of using low interest rates is going to start to decrease.
And what do you think this means for the Fed? Do you think that the ECB's over-delivery and the announcement has complicated matters for the Fed, which will be meeting this week?
Yes, Melissa, it really has. But few expect the Fed to raise interest rates this time. Easing market turmoil, strong labor market, some signs of an uptick in inflation lately give the Fed some wiggle room in tightening monetary policy in the months ahead, but we're not expecting anything now. We're going to be watching what the announcement is. If you take a look, Fed funds futures on Fridays, which are used by both investors and traders to place bets on central bank policy. On Friday, they indicated that there was less than a 50% likelihood of a rate increase from the Fed at its June policy meeting. And the odds for a rate increase at December were 77%. So it looks like the market is expecting perhaps 2 rate increases between now and the end of the year, and it's going to be driven more by the relative strength and the decrease in concern over other markets.
So do you think the Fed is a central bank that is perhaps out of sync with other central banks around the world and maybe even second-guessing itself?
It is out of sync because it is respecting what is happening abroad and the impact in the markets, and it doesn't want to get too far ahead in increasing interest rates relative to what's happening elsewhere. And so it is respecting what is happening, despite the fact that that the United States market internals and economic conditions could support an earlier return than what is being expected now.
Mm-hmm. Okay, and what is your call for the next hike? I mean, you said most analysts are expecting mid-year. Do you think it could come later towards the end of the year, or are you with the consensus?
I'm looking for June, and I suspect that the market will react negatively if it's sooner. I do not expect much between June and the end of the year, and I suspect the second increase will be November and December based on what we see now. And when I say what we see now, I'm looking more at what's happening abroad and where the ECB is and where interest rates are abroad rather than the economic conditions here.
Oh, you're expecting 2 rate cuts, two rate increases this coming year?
Yes, I am, and that's, Melissa, that's based more on my belief that economic conditions are going to improve as we get into the third quarter of this year, not only for the United States, but also abroad, particularly first in Europe and also in Asia.
Okay. All right. Dodge, the other aspect, of course, is U.S. politics. That's another variable markets need to watch out for. The presidential election is still 8 months away. But what political risk impact are you watching out for, Dodge, as the race to the White House heats up?
Oh, Melissa, this is a tough one. It's never been a tougher question than it is this time around. There's so much that's going on. Attempts by mainstream Republicans to block Trump come with a great risk. Whether or not Trump is the lead and becomes the Republican candidate, it could go either way, and there's a risk either way. If he does become the lead, then moderate Republicans may stay home and more Democrats may vote. If he doesn't, then the Republicans may not gain some of the states that he could bring in that they haven't had a particular ability to in the past. There's a sense that Trump and a split with the GOP is going to be incredibly hazardous for the Republicans. But at the same time, there's really no guarantee that another Republican candidate could win either. But one thing, right now, the market is indicating that Hillary Clinton is beatable, but not while Republicans wage this civil war that's going on right now.
Okay, but given all this uncertainty, Dodge, do you think it is, are you watching ahead? Will the elections in any way make you change your asset allocation or change the exposure of your portfolio?
No, we still believe in the rotation. We still see gold, steel and other materials, energy. Energy is coming back. What we're really seeing now, Melissa, is an opportunity to buy those stocks which have been beaten down. There is a rotation towards those. And so, and that is a much longer-term opportunity as opposed to buying those that have had the momentum at the end of the year. So it hasn't changed our outlook. It does allow us to time the purchases a little bit more in connection with market volatility. But we're not as likely to be selling as we were. And what is kind of interesting now, Melissa, is the fact that we're seeing energy beginning to develop a sense that we have seen the lowest price of oil, and that longer term that there will be a bounce. Yes, there will be a pullback, the volatility will continue, but there seems to be more of a confidence being built in that sector towards the fact that we may have seen the lows in prices.
Great. Well, I'll keep an eye on the energy sector. That was DodgeDorland, Chief Investment Officer of LandorFuest Capital Managers in New York.
You're still here. Good. Now, if you're listening to this podcast while on the treadmill, you're already off to a good start. If you're not, don't forget to join us at BFM's Health and Living Live 2016 on the 2nd of April. Find out how you can live a better, healthier life. Go on and register at bfm.my/health.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.
This year, I will chew 117 number 2 pencils.
I will doodle 9 Staples notebooks to death.
When it comes to school supplies, it's guaranteed your kids will go through a lot.
I'll make a whole lot of paper airplanes.
I will lose my backpack.
That's why you get guaranteed savings for back to school at Staples.
I'll give away my last pen to Nathan in math class.
Get guaranteed savings at Staples, and right now, one subject notebooks for just a penny with a $5 purchase. Staples, that was easy. Valid on select SKUs while supplies last. Limit